Green Limited is preparing to set up business on the 1st of the 1st, 2010 to manufacture a single product. Below is the sales budget for the company for the first 6 months of 2010. So you've got your sales units and sales revenue there from January through to June. Number 1, the cash collection pattern from sales is expected to be cash customers, 30% of sales revenue will be for immediate cash. Credit customers, 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. Note 2. The product requires 4 kgs of material X, which costs €1.50 per kg. Note 3. Stocks of finished goods are maintained at 60% of the following month's sales requirements. Number 4. Stocks of raw materials sufficient for 10% of the following month's requirements in kgs are held at the end of each month. Note 5. 1 month's credit is received from suppliers. Note 6. Expenses of the business will be settled as follows. Expected costs. Wages, €20,000 per month payable as incurred. Variable overheads, €5 per unit payable as incurred. Fixed overheads, including depreciation, €29,000 per month payable as incurred. Capital costs. Equipment will be purchased in January, costing €30,000, which will have a useful life of 5 years. To finance this purchase, a loan of €24,000 will be secured at 10% per annum. Interest to be paid monthly, but capital loan repayments will not commence until July 2010. You are required to A. Prepare a production budget for the 4 months January to April 2010. B. Prepare a materials purchase budget in units and in euros for the 4 months January to April 2010. C. Prepare a cash budget for the 4 months January to April 2010. D. Prepare a budgeted trading and profit and loss account for the 4 months ending 30th of the 4th, 2010. If the budgeted cost of a unit of finished goods is €20. E. Prepare a note on the factors taken into account by Green Limited in arriving at the expected sales of 59,000 units for the 6 months of 2010. Okay, so let's get started with part A, which is prepare a production budget for the 4 months January to April 2010. Okay, so the information that we want to look at here is the sales in the units there, and note 3, which says stocks of finished goods are maintained at 60% of the following month's sales requirements. Now, so we're going to be looking at all of the sales units. We're going to be putting them in from January, February, March, April, May, and we're going to put in May's. Why will we want to put in May? Well, we'll want to put in May because we need to know May's sales in order to get the closing stock for April, because note 3 says stocks of finished goods are maintained at 60% of the following month's sales requirements. So into the sales we throw the figures there. Then we're going to do the closing stock. So February, 8,500 multiplied by 60% is €5,100 closing stock for January. That €5,100 closing stock for January is February's opening stock. We minus the opening stock for February because we do not have to produce them because they are already produced. They are already sitting in the warehouse. So we work the whole way across, multiplying the March. So we'll say March multiplied by 60% is our closing stock in February. April multiplied by 60% is our closing stock in March, and May's multiplied by 60% is our closing stock in April. All of the closing stocks in the months will be the opening stock of the next month, which we will all take away because we do not need to produce them if we have them as opening stock at the start of the month. So required for production in January is 13,100. Required for production in February is 9,400. Required for production in March is 10,600. Required for production in April is 11,300 and required for production in May is 10,900 euro there. So that is part A of your question complete. Part B is asking you to prepare a materials purchase budget in units and in euros for the 4 months January to April 2010. So how many kgs of materials do we need to buy in order to satisfy the production that you've just worked out in part A, and how much is it going to cost you to do that? So the information that we're going to look at is note 2, the product requires 4 kgs of material X, which costs 150 per kg, and note 4, stocks of raw materials sufficient for 10% of the following month's requirements in kgs are held at the end of each month. Okay, so let's get started then. So what we do, we take our information from part A into our part 2 here. So this is our raw materials purchases budget. So this here should say raw materials purchases budget. So multiply it by the kilos that are required, which is 4 kgs. Okay, so 4 kgs across the way there. Then required for production in January, 52,400. Required for February is 37,600. Required for March, 42,400. Required for April, 45,200 kgs. And required for May, 43,600. Now we need to do is add the closing stock. So stocks of raw materials sufficient for 10% of the following month's sales requirements in kgs are held at the end of each month. Now there was no opening stock of materials, but 10% of the following month's sales requirements is going to be my closing stock, so 3760 there, which is going to be my opening stock then in February. March multiplied by 10% is going to be my closing stock in February, which is 4240, which is going to be my opening stock then in March. April 45,200 is 4520 kgs of closing stock, which is my opening stock in April. May 43,600 multiplied by 10% is 4360 closing stock. I tot everything up, and then required for purchase, I have 56,160 kgs in January, I have 38,080 kgs in February. In March, I have 42,680 kgs, and in April, I have 45,040 kgs that I need. Multiply that by the cost per kg, which I have been told in note 2, which is €1.50, and I get my cost of raw materials for each month. So in January, it cost me €84,240. In February, it cost me 57,120. In March, €64,020, and in April, 67,560. And again, this should read raw materials purchases budget. Apologies. Okay, so part C, now we're on to our cash budget. So, like our full cash budget questions that you will have already done, this is going to be a shortened version of one of them because we're only asked to do 4 months, January to April 2010. So for this, first of all, we're going to be looking at our receipts and what money have we received. So we're going to be looking at our sales revenue as well as note 1. Note 1 says, the cash collection pattern from sales is expected to be cash customers. 30% of sales revenue will be for immediate cash. Credit customers. 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. So, cash receipts, 30% of 240 is 72 that we're going to receive in January. Then we're going to receive 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. So therefore, 1 month after sale, we're going to receive 35% and then 35% in the second month after sale. So 240,000 multiplied by 35% is 84,000 received in February and 84,000 received in March. February sales revenue, 255,000 multiplied by 30% is 76,500. 255,000 multiplied by 35% is 89,250 and 89,250. March is 300,000 multiplied by 30% is 90,000. 300,000 multiplied by 35 is 105,000. Then in April, 330,000 multiplied by 30% is 99,000. We tot up all of those and they are our receipts. So 72,000 in January, 160,500 in February, March 263,250 and then April 293,250. Now, moving on then, Note 5 says 1 month's credit is received from suppliers. Now, we're not told any purchases up here. We don't have to work out purchases here in this cash budget. What we do have to look at is our part B, where we actually did work out what our purchases were there. Okay, so 1 month's credit is received from suppliers. So I go back to my raw materials purchase budget, okay, and this is my cost of raw materials, and 1 month's credit is received from suppliers. So 84,240 is going to be paid in February. February's 57,120 purchases are going to be paid in March, and then March is 64,020 is going to be paid for in April. Moving on then to the rest of the expenses, expected costs, wages, 20,000 per month payable as incurred, so 20,000 across the board there. Variable overheads, €5 per unit payable as incurred. So we are going to look back at part A where we did our production budget and we're going to multiply all of the units by €5. So 13,100 multiplied by 5, 65,500. 9,400 in February multiplied by 5 is 47,000. 10,600 in March multiplied by 5 is 53,000. And April's 11,300 multiplied by 5 is 56,500. So that's the variable overheads. Then we have our fixed overheads. So fixed overheads including depreciation, €29,000 per month payable as incurred. Now, we know from our cash budgets that we've done previously, and we know from cash flow statements that depreciation is a non-cash item. So it does not involve cash whatsoever. So what we need to do is we need to work out how much depreciation is per month, okay? And we need to take it away from the 29,000 figure in order to just work out what the cash fixed overheads are, okay? So the cash items. So it says here, the fixed asset here, equipment will be purchased in January, costing €30,000, which will have a useful life of 5 years. Okay, so 5 years is 60 months. 30,000 divided by 60 months is €500. So therefore, our fixed overheads are going to be 28,500 per month. So 29,000 minus the 500 depreciation. Then we're going to enter in the equipment. So that was purchased in January and not in any other month. Then to finance this purchase, a loan of 24,000 will be secured at 10% per annum. Interest to be paid monthly, but capital loan repayments will not commence until July 2010. So that's after the period that we're doing this cash budget for. So all we have to do then is work out the interest. Okay, so the loan is 24,000 and the interest is 10%, so that's 2,400 per year. Okay, that's to be paid monthly, which is 200 monthly. All right, and so we are going to pay that every single month there, January, February, March and April. Now we're going to tot up the total payments there. So 144,200, 179,940, 158,820 and 169,220. So we're going to work out the net cash. How do we do that? We take the total payments from the total receipts. So 72,000 minus 144,200 is minus 72,200. 160,500 minus 179,940 is minus 19,440. 263,250 minus 158,820 is 104,430. and 293,250 minus 169,220 is 124,030. Now we got the bank loan in January and the bank loan was 24,000. There was no other bank loans got any other month. There was no opening balance in January. Our closing balance in January is minus 72,200 plus 24,000, so that is minus 48,200. That closing balance in January is my opening balance in February. So minus 19,440 minus 48,200 is minus 67,640. That closing cash balance in February is my opening cash balance in March. So 104,430 minus 67,640 is equal to 36,790. 36,790 closing cash in March is my opening cash in April. So total closing cash balance then for April, €160,820. So that is the cash budget done there for the 4 months. Okay, part D then is asking us to prepare a budgeted trading and profit and loss account for the 4 months ending the 30th of the 4th, 2010. If the budgeted cost of a unit of finished goods is €20. Now, remember that we're only doing it for 4 months, so a lot of people will accidentally add in sales revenue for 6 months here. So sales is 240 plus 255 plus 300 plus 330, so 1,125,000 there. Less cost of sales. So our purchases from our part B, so purchases for January, February, March and April are €272,940 altogether. Then we're going to take away the closing stock. So the closing stock of finished goods, all right, so it's our closing stock in April. If you go back to part A, okay, that is 6,900 units. You'll see it there from part A. Multiply that by €20. And then you add your closing stock raw materials from April, which was in part B, which is 4,360 kgs, and that is at €1.50, which we were told for part B as well. Add those two together and your closing stock altogether is €144,540. Tot those up, that is €128,400. Then your gross profit, €996,600. Then we take away the expenses. So the wages, 20,000 by 4 months, €80,000. Variable overheads then, 65,500 plus €47,000 plus €43,000 plus 56,500 is €222,000. Then your fixed overheads, 28,500 by 4 months is 114,000. Then our depreciation, €500 by 4 months is €2,000. Then we take away our interest. Now your interest can go in here as well. They're fine for you to put it in there also. Interest is €800, so your net profit altogether, €577,800 there. So that is part D, your budgeted trading profit and loss account complete. Now part E. Prepare a note on the factors taken into account by Green Limited in arriving at the expected sales of 59,000 units for the 6 months of 2010. Okay, so last year's sales will be taken into consideration. Market research, or the opinion of sales manager and sales reps. Trends or state in the economy. Price to be charged. Competition.